All right, welcome back to the third lecture video of Chapter 6. So far, we've went through the overview of what a budget is, the sales budget, production budget, all the costs to manufacture, and now we're going to take it one step further and really focus on the incomes or the financial statements. So we'll see today how the operations budget we went through in the past couple lectures helps create the financial statements or the budgeted income statement, balance sheet, and cash flow statement. Hopefully, before you start this, you've worked through the practice problems for lecture video 2 and really took some time at trying to create those budgets and then compare and contrast with the solutions that were posted online. So let's start working through the next aspect of our budget. So like I said, lecture 1 we focused on revenues. Lecture 2 we looked at production and all the costs of production, which will come out into our cost of goods sold. So now what we're going to do the rest of today is look at operating expense budget to get to our income statement and how that will flow through to help create balance sheet and statement of cash flows. So when we're down here in these operating expenses, one of the big ones is your SG&A expense, so selling general administrative expenses. So obviously this includes the budget for all things like marketing, your admin staff, um, yeah, just your general corporate office costs. In this budget, this is probably where the most flexibility in the budget comes from. So a lot of these, it says here, expenses in this budget are often considered discretionary. And so, like we said in lecture 1, that a lot of times you get to the end of your budget and you're hoping for a net income of a certain amount or an ROI of a certain amount. And what we can do is if we're short, lots of times it is what it is. If you can't make any changes, that is what your budget has to be. You're just short of the net income metric you're hoping for. But sometimes what you can do is go back and start saying, okay, where can we cut costs? Where can we decrease our marketing expense or decrease our materials expense? How can we get that budget in line with what we were hoping? And a lot of times, this SG&A line item or expense budget is where you have a lot of discretion. The one bad part about this is managers know this. So a lot of times, in order to make the budget look good for this year, maybe they'll do something like, well, here's an example, cut out the customer service expense. Say, oh, we won't provide as good of customer service. Well, as you can imagine, that might help this year, but that could really harm the firm in the long run. Or perhaps they want to cut marketing budget. They say, oh, our marketing is too high this year. Let's cut that back. Well, if less people know about your product in future years, that could really hurt you. So the big thing about SG&A is it's similar to other aspects. You'll usually start with last year's and you'll make adjustments for there or from that point. So if last year we had $1 million SG&A, but we know we're going to have a big marketing advertisement campaign, so maybe we add on $50,000 to that. Or we know we closed an office, so maybe we can cut back $100,000. So you usually start with last year's and you make adjustments. And remember that this is where a lot of the discretion lies. But also, you really want to make sure if managers are making cuts or making changes to this area of the budget, that they're not doing it with a short-term focus. We want them to be really focused on the long-term implications on this. So that's the SG&A budget. So now we've went through all our operating expenses. We finished all of this, and that really will get us to our budgeted net income. So now, as we've seen, we've looked at costs minus production expenses minus operating expenses, and that'll get us down to our budgeted income statement. And then that will flow through and help us create our budgeted balance sheet. So after your operations, you've budgeted all your operations, you start to make these income statements. As we know, your budgeted income statement will be how you expect your operating income to look at the end of the upcoming period. Same thing with your budgeted balance sheet. It just says at the end of the year, the end of next year, this is the position we think our firm is going to be in. So this is really the last budget that you're going to create. We're going to look through now about creating the cash flow budget, but really the cash flow and the balance sheet budget is going to be another one of those iterative processes where you'll use all the information up to this point to create a budgeted balance sheet, but you'll kind of leave that cash part empty. You'll go back, you'll look through it, you'll do your cash balance, your cash budget, and that will let you know how much cash you think you're going to make or use throughout the year. So in this balance sheet budget, you'll have the beginning cash balance. Then you'll do your cash flow budget, and that will inform if you're going to get more or less out of this beginning and how your ending cash balance will look. So the balance sheet is the last budget we're going to create, but just know that you're going to create everything pretty much except for the aspect of cash. You're going to do the cash balance, and that'll inform your ending cash balance on your budgeted uh, balance sheet. And it'll also inform things like maybe in your cash budget, you change your cash budget because you want to buy more equipment. Well, when you buy that equipment, you'll have to go back and update that in your balance sheet. So just know the relationship between the cash flow budget and the balance sheet budget is a very iterative process. Those two are working together, but the very last one you create and finalize is your budgeted balance sheet. So like I said, you have your income statement. This is going to flow through and help you create your balance sheet. And then your balance sheet and cash flow statement is going to be a pretty iterative process, but the goal is to end up with these three statements: your income statement, your balance sheet, and your statement of cash flows. Those are the three big things in your budget that you're going to want to look at. And we'll get later on, in a different class, we'll get a little bit into this capital expenditures budget, but not so much right now. Right now, we're going to focus on these three numbered ones below. So the cash budget really, as it says, it brings together the cash that you're going to use from all your different activities. There's going to be three sections on your cash budget, and it's going to be your cash available, cash disbursements, so how much you're actually going to pay out, and financing, where you're going to get cash from. And so preparation of this budget involves careful review of all other budgets to identify cash inflows and outflows. For example, if you go through and you're working on your income statement, and in that income statement you put in that, oh, we're going to have to increase production by 20% to meet our sales budget. Well, when you increase that production, you know that you're going to have to buy equipment. So that purchase of equipment is going to flow through into this cash flow budget. You're going to see that as a cash outflow. Or vice versa, you might see when you're doing your balance sheet that you're expecting your accounts receivable balance to go way down, which means when that AR decreases, you're going to receive cash. So now you know that in your cash budget, you can expect to have a cash inflow as your customers slowly pay you back. So again, very iterative process, and all the other things you prepared influence the cash flow. Then once the cash flow is done, you can update your numbers in the balance sheet. So here's our problem. This is a very short lecture, but you'll want to work through this cash flow problem, and just be aware that we're changing companies a little bit. And be very careful when you're reading this. This is one of those managerial accounting problems that puts a lot of information in the sentences. For instance, we know they're made on credit. Direct materials made on credit. They pay 75% of the purchases 1 month of, or the month of sale, and the remainder the following month. And so we know there's purchase terms 210, net 30. So all this needs to be incorporated when you're actually creating your cash budget for these months. And as you'll see, as you work through this, it can get pretty tricky. Um, and these are real life scenarios because these are the types of terms that companies have for their purchases that they need to incorporate into their cash flow. So, just a heads up, when you're working this, be very careful to read thoroughly. And this holds for here as well as quizzes, exams, or when you get out in the real world. You have to be very careful to make sure you're incorporating all these really important aspects of your contracts when you're developing this cash flow. So we've now finished up all our budgets. We've moved through all the way from revenues, production costs, expenses to get the income statement. We'll see how that flows through to the budgeted balance sheet, as well as the budgeted cash flow statement. So now we've seen the relationship between all those. The next lecture, the last lecture for chapter 6, is we're going to look at incentive issues with budgeting. And it's one of my favorites, so I'm excited to get to it. But we'll see that there's some funny stuff that can happen with a budget and how it influences people's behavior. So good luck on the practice problem. Be sure to check your answers with what you see online. And